Please pay attention that the main reason of price movements in financial markets is smart money, the money that flows into market by banks, hedge funds, investment corporations, and other institutional traders who place very large amount of positions in financial markets. They have a better understanding of the market, and with all the power and capital that they have, they can influence trends in financial markets. Now you may wonder if these large players use any special indicator when they want to analyze the market and open a trade. The answer is yes, there is one indicator that banks and institutional traders frequently use, and the good news is that the indicator is free and publicly available for retail traders to use it. I will teach you how you can effectively use this indicator for trading, so just make sure you watch this video until the end and let's get started. Before I add the indicator, I'm proud to announce that recently I published a book, The Art of Price Action Trading. The link is in the description and you can get it later if you're interested to learn price action analysis and take your trading to the next level. Alright, to add the indicator on TradingView platform, here you just need to click on indicators and search VWAP. This one, volume weighted average price, which is a built-in indicator on TradingView platform. Alright, this is the indicator, and as you can see, it is overlaid on the price chart. This indicator is designed for intraday trading, and it's very popular among scalpers and day traders. And this is the indicator that is frequently used by banks or other institutional traders. It is somehow similar to moving average, but it's completely different, and volume is also considered in the calculation. As the name indicates, it's volume weighted average price, so volume also plays a role in this indicator, and the indicator actually puts emphasis on the periods with higher volume. I don't get into more details regarding the formula and calculations behind this indicator because in practice you don't need it, since the indicator is available on most of trading platforms. But in case if you want to know about the exact formula and calculations, you can just simply search in Google and you will find it on many websites. This blue line here is VWAP, volume weighted average price, and these green lines above and below the VWAP line are placed one standard deviation from VWAP line, and they can help you with identifying areas where the price is far above or below the average. First, we go to the settings of the indicator and we remove the bands so the chart will be less cluttered and I can better explain the VWAP line. First of all, as I said, this indicator is designed for intraday trading, so you should have it on intraday time frames. And for example, if you switch your time frame to 1 day time frame, the indicator will lose its effectiveness. It is designed for intraday time frames. And if you go to the settings of the indicator, here you have an option for hiding VWAP line on 1 day time frame and above that. So if based on your trading strategy, you need to analyze daily time frame or above that, you will not analyze VWAP by mistake. So you should use VWAP line on intraday time frame. The lower the time frame, the more effective the indicator. The reason that it should be used on intraday time frames is that the calculation of this indicator starts from beginning of each day separately. So for stock market, the calculation starts from beginning of each day, and for 24 hours market like Forex, the VWAP calculation is started when a new day is started based on the time zone, which is usually set on UTC time zone on brokers. If you have already noticed, there are times that VWAP line suddenly falls, like here in this part, or suddenly advances, like here in this part, which is usually very sharp and nearly vertical, and this is actually where the VWAP line is resetted and the calculation is started for the new day. So here is beginning of the calculation for VWAP line, or for example here is beginning of the calculation for VWAP line. At first you can see that the VWAP line is very close to the price action, and after that the more the price moves forward in the day, the line becomes smoother and we have more distance between the line and the price action. The reason is the VWAP line gives the average prices in a trading day, and the later we look at the VWAP line in a day, the more periods the indicator has already used to calculate the average line, so making it a smoother line and farther away from the price action. So here we have an average line which is averaged during the day and it is weighted by volume. This is exactly what banks and institutional traders need. They don't use it for trend analysis, but rather they use it to evaluate the volume weighted average price during the day, and then they use it as a trading benchmark. The volume weighted average price is considered a fair value for them, and banks use VWAP to make sure that the large positions that they are executing are close to the average price, so they can minimize impacting the market significantly. Actually, VWAP line helps banks or institutional traders to understand the average price during the day, so they will be aware of market sentiment and potential entry or exit points. They usually try to buy below the VWAP line or sell above the VWAP. In other words, when the price is below the average, they buy, and when the price is above the average, they sell. By doing so, they make sure that their trading activities push the price back to the average instead of away from the average, and of course, they make their profit at the same time. In algorithmic trading of banks or institutional traders, VWAP is the key element in their algorithms, which is used for executing trades above or below the volume-weighted average price. Alright, now let me teach you how you can use this indicator as a retail trader. When you are working with this indicator, it's better to skip the opening periods of the market where the VWAP line is not smooth yet and it is moving very closely to the price action, unless you have other indicators or tools and specific strategy for trading in the opening hours of the market where trading volume could be very high with considerable movement of the market because of overnight news and fundamentals. Alright, one of the signals that you can get from VWAP is breakout. Generally, when the price goes above the VWAP line, it tells us that the bulls were strong enough that could manage to push the price to higher than average, like what happened here. So it could be a good opportunity to open a long position. As long as the price remains above the average price, it tells us that buying pressure is higher than selling pressure, and market participants are buying above the average price of the day for a reason. And similarly, when the price goes below the VWAP line, it shows that the bears were strong enough to push the price lower than the average price, and this shows that market participants are selling below the average price of the day for a reason, and this could be a good opportunity for opening a short position. But as I explained earlier, banks and institutional traders do the opposite. They actually use mean reversion strategy, meaning when the price is far below the average price, they try to buy, and when the price is far above the average price, they try to sell. This is what they do, but the exact moment or their desired deviation from the average is not known to us, and depending on the market condition, they may prefer different deviation from average for entering a trade. But the potential moments are when the price breaks VWAP line sharply with considerable amount of volume. For example, here in this part, you can see that we have a very sharp break of the VWAP line and the price declined very sharply, which is nearly vertical. And these sharp movement of the price usually happen with high volume. Let me add volume to our chart so we can better analyze it. We add this one, just an ordinary volume indicator. Alright, as you can see, for this sharp and nearly vertical decline of the price, when we check the volume and compare it to the periods before that, we can see that the volume considerably increased for this decline of the price. These are the moments usually banks and large traders enter the market and the price reverses sharply to the average price. As I said, they don't use VWAP for trend analysis, but as a benchmark for entering a trade above or below the average price. To show you another example, here in this part, you can see that the price broke above the VWAP line very sharply, and we had advancing of the price nearly vertical. And for this sharp advancing of the price, when we check the volume, we can see that the volume also increased considerably, and after that we got a sharp reverse to the average price. Please pay attention that as a retail trader, you should never take your trading decisions only based on VWAP, and you must use it in conjunction with other indicators or aspects of technical analysis for more confirmation. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video and good luck with your trading.